Playing it safe with your retirement money sounds like the safe, responsible thing to do. But there are multiple ways that if you play it safe, that can backfire on you. Today we're going to cover four of them. The first mistake is holding too much cash. If you own a bunch of cash, then that can dramatically decrease your portfolio return. Let's say, looking at it currently, the U.S. 3-month Treasury is yielding at 3.675%, and that's a decent amount, but inflation is roughly around 3%. So if you look at the actual amount of money you are making at the end of the day, it's about flat. So you're not making any money. You're withdrawing essentially from your principal, and we'll assume it's the inflation rate and the U.S. 3-month Treasury rate are about the same. You're only withdrawing from your principal, and there's no gains that you have from that. Now, if you don't think you can reliably generate gains in the stock market, that's a entirely different question. But the issue with inflation is over a 20 or 30-year retirement. Let's say you have no returns. Let's say you have $1 million. You start out with $1 million and you withdraw $50,000 a year. Now, assuming inflation and the interest that you get from treasuries nets out, you end up withdrawing $50K per year. And if you retire and live for 20 years, that's fine. But over 25 years, let's say, you end up with no money. If we use the standard 4% withdrawal rate, then you can end up with 25 years of income. $40,000 a year times 25 is $1 million. However, with retirement being longer than ever, if you live to be, let's say, 87, and you're retired at 65, that's still in that window. You lived 22 years, but let's say you live a little longer than that, maybe 92. What do you do those last 2 years? Do you spend all your assets, or do you still have some money left? Obviously, you don't want giant piles of money left, but is there still something for you left to live on? The second mistake is over-reliance on bonds. Bonds are great. And if you look at, this is the current yield of the 30-year bond, it's yielding about 5% now. If you had bought in 2021, you are in a lot of pain now, but if you buy now, they're yielding about 5%. And why can't I just buy a bunch of bonds? No. This comes with the same issue that buying a bunch of holding a bunch of cash does. You get a little higher yield, yes, but there isn't that much that you're growing your assets by. And if bond yields go up, that's another risk. So maybe even that's not safe. Using the definition of safe we used earlier. It's one of the, when you say something in finance, it's debatably the most critical aspect is defining exactly what you mean. For instance, if I say safe, do I mean all in U.S. treasuries? No, or do I mean like a balanced portfolio? And with bonds, we can look at, this is from the 2008 peak. So this should, in the stock market, or 2007 peak, this should literally be the best performance for bonds. And you can see that they outperformed the market going into 2020. February 2021 even. But today, with the S&P at 7,500, Bonds are still far behind, and you would have to return to the COVID lows to have the same amount of money. Now, does this mean there can't be extra volatility and that you should be all in stocks? Absolutely not. You should have bonds and you should have stocks, but they should be balanced. The next mistake that we're going to cover is just if you're taking Social Security too early, which can seem like the safe decision, you lock in your benefit. Maybe you're not even going to receive most of Social Security because of the 2032 or 2033 bankruptcy, or not bankruptcy because benefits will still be paid out from incoming taxes, but insolvency. And maybe they have to cut benefits and it ends up being a great decision. But then again, maybe they don't. Maybe the politicians figure out another way to add on more debt and keep on paying out the benefits. That's probably the most likely thing to happen, honestly. But if you take your benefit too early, you can end up leaving a bunch of money on the table. If you take it 62 versus 70, or even if you... One strategy is one spouse takes out early and the higher earning spouse, waits until 70. So let's say one lives till 95. They still get the higher earning spouse's Social Security check. Anyway, these are just 4 things that you should think about when you say you want a safe retirement plan. If you're interested in more videos like this, please click the like button and subscribe. Thanks.